This presentation, we're going to talk to you about profitability ratios. And so these are generally, some amount of profit or some net income, those kinds of measures divided by some base. And they are used to try and figure out basically how much profits being generated on the basis of that base. Um, so these are certainly considered an efficiency measure. Um, it's really about how well they use their investments to generate profits. The kind of three big ones: profit margin, return on assets, return on equity. I would say of the non market based measures, these are probably the most widely used and known financial ratios in the industry. So let's talk about them. Profit margin, exactly what you would expect: net income over sales. And so sales might be revenue. Sometimes they're referred to the same. And obviously, you generally would like higher profit margins relative to your peers or relative to prior periods. All of that suggests that you're spending less um, um, to generate each dollar revenue. Because if you think about it, sales minus expenses equal income, net income. So if your net income is going up, it must mean that your expenses are going down relative to sales. Um, Generally speaking, if you're a firm that competes on price, you'd look at an increase in the profit margin, say, "Good job, we've obviously found a way to cut costs more." If you compete on quality, actually having your profit margin go up may be a little bit of a concern to you. It could indicate that maybe you're not delivering the same level of quality you thought before. Realize quality and cost don't go hand in hand, but it's certainly something you would watch. So it's not always the case in every industry and for every firm in every industry that their goal is always to have profit margins be as high as possible. Um, and the way that's usually used, profit margin is definitely more of a management type number. And so a lot of times managers are asked to either reduce or maintain this within some range. And obviously, if they're outside the range, come back inside the range, whatever you have to do. The next measure, return on assets. This one and the one that comes after it, return on equity. A lot of times those get confused and people don't understand the difference. Hopefully, I can clear some of that up. So, both of them, you've got net income in the numerator, book value of assets, so assets as they're reported on the financial statements in the denominator. Um, in some sense, if you think about before, you've seen this before. The asset turnover ratio is sales over assets. Um, this is more focused on profit, and so it's net income, not just sales. And so that's a probably more of interest than sales, right? But each of them's interesting. One of them says, "Wow, you're just not generating any real sales with this. You need to go out and do a better job of selling." The other one says, "Maybe you're doing a good job with your sales, but you're not generating enough profit from your sales, and so your problem isn't sales, it's profits." Um, these percentages can certainly vary widely across different industries. Again, partly because of the income, but mostly because different industries have different assets. Some again, you can have very asset intensive businesses that require a lot of equipment, so forth, versus not. So you really can't compare these across industry. But within an industry where sort of everybody has the same issues and so forth, you should generally be able to compare this. And in fact, a lot of investors do. And absolutely, it's the kind of thing that you ought to be able to track from period to period and get a sense whether your efficiency is trending up or down, the efficiency of profits to assets. Um, and sometimes the question is, well, if it's not good, what do you do about it? Well, obviously, one thing you could do is reduce your expenses or increase your sales, and that'll help the net income side of it. But one that a lot of people overlook is you can also go look and see whether I'm maybe holding too many assets. Sometimes a company has a bad return on assets because they've got some non-productive assets that they bought. Maybe they bought them thinking there was going to be some big growth in their sales, and it never happened. or maybe it happened, but it's that growth is past and the industry's in decline, or they just don't do a good job of managing their assets, and they've got them sort of dispersed out in different places and not using them, and they buy a new one instead of using the ones that they have, or whatever else. I've seen a lot of reasons for this, being a bad number. So one company compared to other companies in the same industry has quite different or lower return on asset. And there have been a lot of times that it's just that they really aren't actually keeping track of and managing their assets and selling them when they need to. Last measure is return on equity. So that is net income over book value of equity. And so whereas the last one was net income over assets, this is equity. So we're leaving out the liability side. Remember that assets are equal to liabilities plus equity. So we're ignoring the liability side. And the idea here is this is probably the measure that's most important to equity holders. It's not as comparable as the others because the ROE can be impacted by leverage. So it's not the case that you always expect one company to do, to have the same ratio as another if they're in the same industry, because they may have different leverage. But it absolutely is something where if you're an equity holder, you're looking at it and saying, well, you have my money that you took from me when the stock was sold, right? Assuming it's the amount of money that the original share stockholders paid to the company. So you have that money, and you have the money you've retained in retained earnings throughout this time. And I want to know what kind of a return in terms of net income I'm getting on that. Now, this isn't the same as return on the amount they paid for the stock out in the market. So we want to make sure we're not comparing those. But that's kind of the focus. The only difference mathematically between return on equity and return on assets is leverage. And so how much debt there is. If a firm had absolutely no liabilities, it was 100% equity financed, the return on equity and return on assets would be exactly the same. However, as you add more liabilities, then the return on equity should go up. Well, it should get greater. So it'll go up if it's positive, it'll go down if it's negative. And it'll go up by more as more of the assets are funded by debt. So as your leverage ratio goes up. So you could either improve this by improving your return on assets or by increasing your leverage. That last point sort of ties into sort of an interesting set of ratios and an approach that was basically popularized by the Dupont Chemical Corporation. Dupont Corporation, which is a chemical company, in the last century. And they used it a lot to measure, manage, and communicate how the firm was doing. And basically, it takes the return on equity measure and breaks it into components. And so as you saw in the last one, return on equity is basically return on assets times the leverage ratio. Return on assets is net income. Leverage ratio is assets over equity. And so return, if you thought about that, this times this, you cancel it out, it just becomes net income over equity, and that's ROE. So it's a simple algebraic way of getting to that. And then if you also thought about it, return on assets is profit margin times asset turnover. Net income over sales, sales over assets, the sales cancel out. It's net income over assets, and that's return on assets. And so ultimately you could take return on equity and break it into profit margin, right? The first part of the ROA, asset turnover, the second part of the ROA, and leverage ratio, that ROE thing that gets added to it. Now, other than just being a cool, for a finance geek like me, algebraic sort of thing, why do we care about this? Well, here's the deal. When you break it out that way, it speaks very specifically to both why your ROE is what it is and where you as a manager can improve. So for example, if you look at your ROE and you basically say, asset turnover and leverage ratio are pretty much like they were last period, but profit margin has changed, it's down, then you can say, oh, if I do things to improve my profit margin, I'll get my ROE back in line. Same thing if maybe it's good, the leverage ratio is good, your asset turnover is not good, then you need to improve your asset turnover. And remember that as we talked about with the ROA, because that's a part of it, that could come from let's just focus on getting better productive assets or better sales out of our assets, maybe sell the assets that are non-productive. Or maybe it's those are both in line, but I just have a very different leverage ratio than the rest of my competitors, higher or lower. And so if I wanted to, I could improve my ROE by increasing the amount of debt financing I have, and so increase the leverage. Now, the one gotcha I will say related to that, you just have to be careful of, is when you start increasing debt, you also increase interest charges. And when you increase interest charges, that's going to drive down your profit margins a little bit. So you have to be sure that you go through the entire calculation sort of on a pro forma basis if you're thinking about doing that, and make sure that the impact on the profit margin doesn't wind up being bigger than the benefit from the leverage ratio. Generally, you should not expect that to be the case, but you just have to be careful. Particularly true as you start getting companies that have a lot of debt, because when you go above a certain amount, you're not only talking about changing the cost of interest of, say, a new debt, something new you borrow, it could trigger them to go back and change the interest charges on all the debt, and you just want to be careful with that. So anyway, just sort of a cool management angle to how you can take that ROE and sort of tie it back to some of the other ratios and think about it for managing the firm. I do appreciate that. You guys are listening to this. I know I'm a geek for bringing that up.